Cathie Wood, the originator of bend speculation. The executive said any choice by the central bank to raise financing costs as the yield bend modifies would be a mix-up. U.S. government security yields arrived at new degrees of reversal Friday, after a solid jobs report bolstered bets that the central bank will increase the size of its next rate hike. A 2-year rate exceeded the third year for first time since 2007, while other parts of the curve, including the 5-year and 30-year segment, already inverted. The Fed seems to be playing with fire, she wrote in a series of tweets on Saturday. Yesterday, the yield curve, as measured by the difference between the 10-year Treasury and 2-year Treasury yields, inverted, suggesting that the Fed is going to raise interest rates as growth and/or inflation. She composed market analysts have learned over many cycles that the 10 to 2-year measure of the yield curve leads another one, the difference between the 10-year Treasury yield and the 3-month Treasury rate. I have no clue about why numerous planners and business analysts are returning to the last one now. The 10-year to 3-month yield curve is steep because the Fed is telegraphing aggressive interest rate hikes in the face of inflation that has been stoked by supply shocks. Inflation is a highly aggressive tax that is killing purchasing power, and consumer sentiment, as measured by the University of Michigan, is lower today than it was at the depths of the coronavirus crisis. It has entered 2008-2009 territory and is not far from the all-time lows in the 80s when inflation and interest rates hit double digits. The economy succumbed to recession in each of those periods. Europe and China also are in difficult straits. The Fed seems to be playing a fire, she concluded. The central bank raised loan fees, interestingly, the pandemic last month, while motioning undeniably more climbs and cautioning that expansion would stay high through the remainder of the year. The quarter-point loan cost climb was normal and considered humble. However, the Fed dramatically increased the quantity of rate climbs guessed for the current year for a sum of 7 to assist rein in the most elevated expansion in 40 years, with enduring month denoted the top-notch climb starting around 2018. The Fed load-up has confronted analysis that it has misjudged expansion throughout the most recent year, and presently considerably more vulnerability sneaks. Energy costs are spiking, a direct result of the conflict in Ukraine, and court IRS floods are closing down significant Chinese assembling centers, deteriorating worldwide production network growls that are pushing costs higher. Expansion has quite far to fall before it comes near typical levels. Yet the Fed needs to abstain from interceding too powerfully or unexpectedly, which could cause a downturn. The Fed expects expansion will stay high, hitting 4.3% toward the year's end in any event, considering loan fee climbs as indicated by new projections delivered toward the finish of the Federal Reserve's two-day strategy meeting last month. Any further loan cost climb will probably immensely affect customers, from advances in ventures to investment funds, work prospects, and costs for labor and products. The Fed's tools are limited when it comes to lowering prices. Monetary policy is not intended to respond to short-term blips in the economy, such as an energy shock, yet such shocks have the potential to weigh on the economy, especially the longer they last, forcing the Fed to consider more aggressive moves and coming rate hikes to address surging energy prices. The White House, as far as concerns, it has investigated a third delivery from the essential oil hold and is thinking about an interruption of the government gas charge. The organization is additionally cautioning oil and gas organizations not to save costs misleadingly high for American purchasers. Inflation has cast a shadow over the economy. Recovery early looks at consumer sentiment and March showed it had fallen to its lowest level since 2011, according to University of Michigan survey data, as incomes took a beating from rising fuel prices. Consumers said they held very negative prospects for the economy. Apart from the job market, the Fed's rate increase is considered a moderate move, and Republican critics have maintained the Fed's rate hike is too little too late. Rate hikes also tend to operate with a lag. Larry Summers, Depository Secretary under President Bill Clinton, cautioned in a Washington Post segment last month that the rate climb was sufficiently not and would prompt stagflation and downturn. Anyway, Cathie Wood has cautioned the Fed that further climbing loan fees would be a gigantic slip-up for much of the past year. Fed authorities have said expansion would be an impermanent component of the recuperation and restricted to parts of the economy hit hardest by the pandemic after some time as greater expenses spread to lease food and everything. In the middle of that message stood out from what was really unfurling in the economy and in individuals' resides. That is particularly the situation for families scratching by to cover the rudiments and for whom lease food and gas make up a tremendous portion of everyday costs. Inflation has hit lower-pay laborers harder despite the fact that they have seen the absolute quickest wage development during the pandemic. Those gains are being disintegrated by rising costs. In the interim, meanwhile, wealthier Americans have stronger protections against rising prices and can cushion inflation's bite by dipping into savings, tapping home equity, or cutting extra spending. We concur with Cathie Wood that further revenue climb will hit Americans hard and will make U.S. buyer feeling tumble to a record-breaking low. We would like to continue the discussion in the comments as we are interested in knowing what your esteemed viewers think on this issue. Will additionally financing cost climb be an enormous error by the Fed, or will the economy fall into stagnation assuming the federal authorities neglect to raise the loan cost? Additionally, we should hear your perspectives in the comments. Thanks for watching our video.